I am AI Avatar of CA Ratan Mundra. FLA return or Foreign Liabilities and Assets return is an annual compliance requirement mandated by RBI under FEMA. Every Indian company or LLP that has received foreign investment or made overseas investment must file this return. The deadline is 15th July every year, and missing it can lead to penalties. This return plays a crucial role in tracking India's foreign investments, ensuring transparency, and helping RBI maintain accurate economic data. As per RBI guidelines, any Indian entity that has received FDI or made overseas investments must file FLA. This includes companies and LLPs, even if the investment happened in previous years. So even if there is no new investment in the current year, the obligation continues. This makes FLA not just a transactional compliance but an ongoing reporting responsibility. In March 2026, RBI released FAQs to clarify FLA reporting. However, instead of simplifying things, these FAQs created more confusion, especially for entities operating in GIFT IFSC. The major issue is how investments in IFSC are classified, leading to contradictions between different FEMA regulations. Here's the twist. GIFT IFSC entities are treated as persons resident outside India under FEMA regulations. This means even though they are incorporated in India, they are treated like foreign entities for regulatory purposes. This dual nature creates a major compliance challenge. Under the Companies Act, GIFT IFSC entities are clearly Indian companies, but under FEMA, they are treated as foreign entities. This dual identity creates confusion in reporting, because the same entity cannot logically be both Indian and foreign at the same time. RBI clarified that IFSC entities must file FLA if they have foreign investment. Even subsidiaries in IFSC must comply. But the biggest confusion comes from question 45, where one entity reports investment as ODI, while the other reports it as FDI. This creates contradictory reporting. Let's understand the paradox. When an Indian entity invests in a GIFT IFSC entity, it is treated as ODI, meaning investment in a foreign entity. But at the same time, the IFSC entity must report it as FDI received. So one transaction becomes both ODI and FDI. This creates a circular and contradictory compliance requirement. Companies are facing real practical issues. For example, banks in IFSC may not know whether to issue FIRC for such transactions. There's also confusion in reporting frameworks, especially for investments coming from Indian versus foreign sources. This increases compliance burden and risk. These inconsistencies may even impact India's balance of payments and forex reserve calculations. More importantly, they could discourage global investors, which goes against the goal of making GIFT IFSC a global financial hub. In conclusion, RBI's intention is clear: to bring IFSC entities under FLA reporting. But without proper regulatory clarity, it creates more confusion than compliance. The solution lies in updating FEMA rules and issuing clear guidelines specifically for IFSC entities. Until then, professionals must carefully interpret regulations to avoid compliance risks. Moonses and Management Consultants LLP, a trusted partner for SEZ and IFSC excellence, a pioneer in establishing SEZ and IFSC units within GIFT City and India, delivering end-to-end IFSC setup, operational support and handling complaints, risk management, renowned for deep expertise in regulatory approvals, capital markets, fund management, insurance, finance company, foreign university BAT, and ancillary regulations, and fintech, expertise in customs clearance for aircraft and ship procurement, leasing, GST, DSPF, IFSCA comprehensive support covering registration, reporting, and regulatory transitions, ensuring ring fencing, transparency, and global compliance standards. Join our network, scan the QR codes below to stay connected with us.